Hi, I am OG John AG. And right now, as you are watching this, it is February 27th, 2026. And today is the day, not next week, not next month, not some theoretical future event that analysts have been debating for months. Today, right now. As the markets open this morning, COMEX March Silver enters first notice day. And I need you to understand something before we go one step further. 2 days ago, on Wednesday, February 25th, 2026, at 12:11 p.m. Central Time, CME Group halted all metals and natural gas futures trading on the Globex electronic platform. They called it a technical glitch, a system error. Nothing to see here, move along. But here is what they didn't say. The halt happened exactly 48 hours before first notice day. Shanghai silver was trading at $104 per ounce at the time of the halt. COMEX silver was at $90. That is a $14 premium China was paying for real metal, while the paper market was frozen. And on the very same day they halted trading, JP Morgan raised its long-term gold price forecast by 15% to $4,500 an ounce, while maintaining its year-end 2026 target of $6,300. The same bank that issued 99% of January silver deliveries. The same bank that closed 633 short positions at the exact bottom of the January 30th crash. They raised their price target on the same day the exchange they effectively control went dark for 35 to 50 minutes. You tell me if that is a coincidence. And now this morning, markets have reopened. First notice day is here, and COMEX has 82 million ounces of registered silver sitting in its vaults against 529 million ounces of open interest in the March contract. That is a 6.4 to 1 mismatch. And if you have been following this channel, you know I have been tracking this number every single day for weeks. The math has not changed. The inventory has kept draining. And now the day has arrived where traders holding long March silver contracts must declare whether they want physical delivery or whether they are rolling and walking away. This is not a drill. This is not a theory. This is the day the paper market meets physical reality. And before I walk you through everything, I need to address something that came out yesterday, Thursday, February 26th, that almost nobody is talking about in mainstream media. There are credible reports documented on Reddit, Substack, and silver community channels that COMEX offered cash settlements to long contract holders before first notice day. Reports suggest that 44 or more million ounces worth of March contracts were quietly offered cash incentives to close out their positions rather than stand for delivery. Let me say that again so it sinks in. Before a single delivery notice was officially filed, before first notice day even arrived, the exchange appears to have been going directly to long holders and essentially saying, "Here is cash, please do not ask for physical silver." If that is true, and the data trail supports it, then what you are watching is not a normal commodity market. What you are watching is a system that knows it cannot deliver, trying desperately to manage demand before the formal delivery process begins. Looking at the numbers, roughly 75% of you watching are not subscribed. If this kind of documented, verified analysis that cuts through the noise and shows you what is actually happening in real time is valuable to you, hit subscribe right now. This is the most important day in silver market history in years, and I will be covering every development. If you are getting clarity here, drop OG John AG in the comments. That is how I know this community is locked in. If it is not for you, no hard feelings. I am not here for empty metrics. I am here for the people who want the truth. Now let me walk you through everything that has built up to this moment and exactly what the numbers mean today. Let us start with February itself, because February has already shattered every historical record before March even begins. COMEX. February silver deliveries saw 50 million ounces leave the vaults. 50 million ounces in a minor delivery month. To understand why that number is staggering, you need context. Historically, a minor month like February sees perhaps 5 to 10 million ounces. We are talking about a delivery rate that is 500 to 1,000% above historical averages. And March is traditionally 3 to 5 times larger than February in terms of delivery demand. If March even approaches 50% of February's rate, adjusted for its historically larger size, we are looking at potential delivery demands that dwarf anything the registered inventory can handle. The February delivery rate was running at 98%, not 2 to 5%, which is normal. 98%. That means out of every 100 contracts that came up for delivery in February, 98 of them demanded real, physical, tangible metal. That is not a speculative market. That is an industrial allocation crisis. That is people and institutions saying they do not trust paper promises anymore and they want the actual ounce. Now let us look at the exact inventory situation as of this morning. COMEX registered silver, the metal actually approved, and sitting in vaults available for delivery, stands at approximately 82 million ounces. Some sources show as high as 88 million, depending on the most recent nightly update, but directionally, the number has been falling every single day. Back in October 2025, registered inventory was 167 million ounces. It has been cut in half in 5 months. The drain rate has been running at roughly 785,000 ounces per day. And March open interest coming into first notice day is 529 million ounces. If only 15% of that open interest stands for delivery, that is 79 million ounces demanded against 82 million available. COMEX is functionally wiped out at 15% delivery demand. If 25% stands for delivery, you need 132 million ounces. The inventory does not exist. If demand hits the February rate of 98%, you need 518 million ounces. The inventory does not exist on this planet in deliverable form anywhere near COMEX vaults. This is the math. And no amount of CME press releases about technical glitches changes the math. Now I want to address the CME trading halt specifically because this matters enormously and the timing is too precise to dismiss. On February 25, 2026, at 12:11 p.m. Central Time, the CME's Global Command Center flagged a system problem. 4 minutes later, the exchange confirmed a full trading halt across all metals, futures, and options, as well as natural gas, on the Globex platform. The halt lasted approximately 35 minutes for options and 50 minutes for futures. When trading resumed, silver had been pushed down from the session highs. Now here is what makes this different from a random technical glitch. The last time CME halted precious metals trading was in a period when silver subsequently surged 127% over the next 60 days. The halt on February 25, 2026 happened at the worst possible moment for anyone trying to contain the delivery pressure building in the March contract. Shanghai spot silver was at $104 at the time, a $14 premium over the halted COMEX price. When an exchange goes dark 48 hours before the most consequential delivery day it has ever faced, in a market where physical demand is running at 98% of open interest, with Shanghai paying $14 more per ounce for real metal, you are not looking at a routine server issue. You are looking at a system under stress trying to manage outcomes. That is not conspiracy theory. That is the logical conclusion of the evidence in front of us. And then there is the cash settlement question. Here is what is documented. COMEX March silver open interest dropped sharply in the days leading up to first notice day. On February 25th and 26th combined, open interest fell by a reported 44+ million ounces. That is an extraordinary collapse in open interest in the 48 hours before delivery begins. Normal pre-first notice day rollover involves positions gradually moving to the next active month. But a sudden 44 million ounce drop right after the trading halt, combined with reports from multiple credible sources that long holders were being approached with cash settlement offers before formal delivery notices were due, paints a very specific picture. The COMEX was trying to reduce the number of contracts standing for delivery before they had to officially process delivery notices. They were essentially buying time and buying out longs. Here is the thing about cash settlements. If you are a long contract holder and COMEX offers you a premium above spot to cash settle and walk away, most paper traders take it. They are not in the silver market because they want silver. They are in the silver market to trade. Give them a premium in cash and they are gone. But the 10,526 contracts that reportedly refused the cash settlement, those are the ones to watch. Those are the longs who said no. Those are the people who want the metal. Those are the industrial buyers, the institutional accumulators, the entities that need real silver. And those 10,526 contracts refusing cash settlement represent 52.6 million ounces of delivery demand from people who cannot be bought out, against 82 million ounces registered. That alone would leave roughly 29 million ounces of registered inventory after satisfying just the contracts that refused cash. Now you start to understand why COMEX offered cash in the first place, and why the trading halt happened when it did. Now let me put this in the broader market context because this COMEX situation does not exist in isolation. JP Morgan raised its gold price forecast to $6,300 for year-end 2026 and raised its long-term forecast by 15% to $4,500 per ounce. They did this on February 25th, the same day as the trading halt. UBS raised its target to $6,200 for gold by March, June, and September of 2026. Jefferies had raised its 2026 gold forecast to $5,000 just weeks earlier. Gold is currently trading near $5,200 per ounce. Silver is at approximately $87 per ounce this morning, down from $90.75 on February 25th, pressured by two factors I will explain in a moment. The gold to silver ratio sits around 59 to 1. At the January peak when silver hit $121, that ratio had compressed to 30 to 1. If gold holds $5,200 and the ratio compresses back to 50 to 1, silver trades at $104. If it compresses to 40 to 1, silver is at $130. The math works both ways. Now let me explain the two forces currently suppressing silver despite the delivery crisis. The first is the U.S.-Iran nuclear talks. The United States and Iran are conducting their third round of nuclear negotiations in Geneva. The talks center on Iran abandoning its nuclear infrastructure development in exchange for relief from crippling sanctions. When those talks began making progress, safe haven demand for gold and silver temporarily retreated. Gold is held near $5,200. Silver dropped from $90 to 87 francs. But here's what you need to understand about the Iran trade. These negotiations have been described as a tense standoff. The U.S. wants a complete rollback of nuclear infrastructure. Iran wants sanctions relief first. This is not a done deal. If talks collapse, safe haven demand comes roaring back. If there is a military escalation, the safe haven bid goes vertical. Silver, which is both an industrial metal and a monetary metal, benefits from both scenarios. The second pressure on silver right now is profit-taking, going into a major delivery event. Some traders who bought the dip in the $72 to $74 range and rode silver back to $90 are now taking profits before the March delivery storm unfolds. That is rational behavior. Lock in gains before a potentially binary outcome. But the profit takers are not changing the underlying dynamic. They are just creating temporary price suppression that smart money is using to accumulate. Now let me talk about what the physical market is saying, because the physical market and the paper market are screaming in completely opposite directions, and they have been for weeks. Shanghai spot silver was at $104 on February 25th, when COMEX was halted at $90. That is a $14 premium. Even after the profit-taking that pushed COMEX silver back to $87 on February 26th, the Shanghai premium held above $10. Physical silver in China continues to trade at a double-digit premium over the paper market. That has been the consistent signal throughout this entire period, and it has not broken down. American silver eagles are still selling with premiums of 20% to 30% above spot at major dealers. Perth Mint delivery times remain at 8 to 10 weeks for standard orders. SD Bullion, one of the largest online precious metals dealers in the world, has publicly stated the market is under real strain. Silver lease rates, which measure how expensive it is to borrow physical metal, have exploded from 0.3% to 8% annualized. That is a 2,600% increase in lease rates. When the premium to borrow silver goes from 0.3% to 8%, it means physical holders are demanding massive compensation to lend their metal out because they think the metal will be worth significantly more when it comes back to them. That does not happen in a market where supply is comfortable. That happens in a market where physical silver is genuinely scarce. And here is the detail that ties everything together. Silver is currently in backwardation. Spot price is trading above futures price. In a commodity with ample supply, futures should trade above spot because of storage and carrying costs. When spot trades above futures, it means the market is paying a premium to get metal right now, today, immediately. Backwardation is a shortage signal. It is the market saying the metal that exists today is worth more than the metal promised to exist tomorrow. And silver is in backwardation, at the same time that COMEX has 82 million ounces registered against 529 million ounces of open interest, at the same time that the exchange mysteriously halted trading 48 hours before delivery began, at the same time that cash settlement offers were reportedly going out to long holders before first notice day. Connect those dots. Let me now address who is watching this. About 70% of this channel are long-term stackers. You have been accumulating physical metal for years. You have a thesis. You have a plan. And if you are wondering whether today changes anything for you, here is my answer. Today is the confirmation of everything you have been building toward. The delivery crisis you have been tracking for months has arrived. The inventory drain you have been watching has continued straight through to the most important delivery month of the year. The physical premiums you have been paying at your local coin shop, those are not anomalies. Those are the physical market correctly pricing scarcity, while the paper market has been trying to hold the fiction together. For you, the long-term stacker, today is not a day to panic. Today is a day to watch carefully and let the data play out. The math is on your side. Physical will win. The only question is when. For the short-term traders in this community, here is the framework for today specifically. First notice day means delivery notices start flowing this morning. Watch how many contracts stand for delivery in the first official daily count. If the number that formally stands for delivery is below 10,000 contracts, 50 million ounces, the cash settlement offers worked and the near-term delivery pressure is manageable even if the structural situation remains dire. If the number is above 20,000 contracts, 100 million ounces, COMEX is in a crisis that no amount of technical glitches or cash offers can paper over. The registered inventory simply does not exist to fulfill that demand. And the exchange will face an existential choice between calling for more eligible metal to be upgraded to registered status, which takes time, or cash settling delivery notices against the wishes of the holders, which is a de facto default, or sourcing metal from outside COMEX vaults, which requires paying whatever premium the physical market demands. Each of those outcomes has different price implications, but none of them are bearish for silver. The worst-case scenario for silver in any of those outcomes is a temporary spike and then consolidation. The best case is a short squeeze that sends silver through $100 and toward the $121 all-time high that was hit on January 29, 2026. Now let me give you the technical picture because you need both the fundamental analysis and the chart levels to navigate today properly. Silver is currently around 87. The key levels to watch today, tonight, and through the delivery period are these. $85 is immediate support. That is where the 50-day exponential moving average sits, and where buyers have been stepping in consistently since the February recovery began. Below $85, the next significant support is $82 to $83. That is where the previous consolidation zone held before the push to $90. Below $80, and you are getting dangerously close to the $76 to $78 zone, where the last major bounce originated. That is maximum pain for bulls, and the place where physical demand historically overwhelms paper pressure. On the upside, $90 is resistance because that is where profit-taking has been occurring. A clean break and hold above $90 opens up $95 as the next target. Above $95, the path to retesting $100 becomes clear. And if we reclaim $100, the January all-time high of $121 is back in view. Gold is providing the tailwind. JP Morgan says $6,300 by year-end. The macro backdrop of tariff uncertainty, dollar weakness, Federal Reserve policy ambiguity, fiscal deficits running at $2 trillion annually, and central banks buying 60 tons of gold per month has not changed. The structural bull market in precious metals is intact. Today is a delivery stress test, not a fundamental turning point. Now let me put the bigger picture together because it is important to step back and understand the magnitude of what is happening. This is not the first time a delivery squeeze has been feared at COMEX. In 2011, silver ran to $49 on hunt-like dynamics before a series of 5 consecutive margin hikes in 1 week by the CME crushed the speculative positions and silver fell 30% in 5 days. In 2020, the Wall Street silver Reddit movement drove physical demand to unprecedented levels. But neither of those situations had the combination of forces we have today. In 2011, COMEX inventory was abundant. In 2020, the delivery rates never approached what we are seeing in 2026. What is different now is the 6th consecutive year of silver supply deficit. What is different now is China's export restrictions on silver that locked 60 to 70% of global refined output inside Chinese borders. What is different now is that February 2026 just delivered 50 million ounces out of a minor delivery month, a number that has never been seen before. What is different now is that the Shanghai premium has been consistently double digits for weeks, meaning the physical market and the paper market have structurally decoupled. What is different now is the AI-driven industrial demand. Silver is not just jewelry and coins anymore. Silver goes into every solar panel, every electric vehicle charging station, every semiconductor, every 5G tower, every missile guidance system. You cannot build the energy transition without silver. You cannot build data centers for artificial intelligence without silver. That demand is not going away because some hedge funds are taking profits or because Iran is talking to the US in Geneva. The structural deficit is real. The inventory drain is real. The delivery rates are real. The Shanghai premiums are real. And now the first notice day math is real. 529 million ounces of open interest against 82 million ounces of registered silver. Let me also tell you about the report that came out 3 days ago from the Silver Institute that every single person watching this needs to understand. The Silver Institute confirmed that 2026 will be the 6th consecutive year of a silver supply deficit. The projected deficit for 2026 is 67 million ounces. Annual global mine supply is forecast to rise just 1.5% to 1.05 billion ounces, a decade high. But demand, driven by industrial fabrication at record highs, solar energy deployment accelerating, EV battery production ramping, and now AI data center construction adding new industrial consumption, is forecast to hit 1.12 billion ounces. Demand minus supply equals a 67 million ounce shortfall for the sixth straight year. In a market where every previous year's deficit has been pulling metal out of above-ground inventories, reducing the buffer available for physical delivery demands. This is why Wheaton Precious Metals signed that $4.3 billion deal on February 17th to secure silver from BHP's share of the Antamina mine in Peru. You do not commit $4.3 billion to lock in silver supply for 25 years unless your models show that the structural deficit is not going away. And now this morning, as markets open on first notice day, all of that builds to a single number. How many March contracts are standing for delivery? That number will update throughout the day, and I want you to think about what each scenario means. Scenario 1. Under 10,000 contracts stand for delivery. Below 50 million ounces. The cash settlement strategy largely worked. COMEX avoids an immediate crisis. Silver dips on the relief, potentially back to $84 to $86. But the structural situation is unchanged. Registered inventory is still 82 million ounces. The 44 million ounces already offered cash settlement are gone from open interest, but the fundamental deficit continues. The delivery problem is deferred, not solved. Watch for April and May delivery month demand to accelerate as longs who accepted March cash settlements decide they want real metal by May. Scenario 2. Between 10,000 and 25,000 contracts stand for delivery. Between 50 and 125 million ounces demanded. This is the partial squeeze scenario. COMEX can handle 82 million ounces if some additional eligible metal is quickly upgraded to registered status. But they will need to source metal aggressively, pay premiums, and the lease rates will explode. Silver rallies back to $90 and potentially breaks it. This scenario creates the setup for an accelerating squeeze over the March delivery period, which runs through the end of the month. Scenario 3. Above 25,000 contracts stand for delivery. Above 125 million ounces demanded. This is the scenario where the math breaks publicly and visibly. COMEX cannot deliver 125 million ounces against 82 million in registered inventory without a combination of sourcing emergency metal, cash settling longs involuntarily, or implementing emergency rule changes. Any of those options triggers a market reaction. Silver breaks above $90. The short squeeze dynamic ignites. Momentum traders pile in. Physical premiums go parabolic. The $121 all-time high gets retested potentially within days. And if COMEX is forced to publicly cash settle longs who demanded delivery and did not consent, that is a de facto default. Not a legal default. Not a technical default that triggers CDS contracts, but a functional default where the exchange could not deliver the silver it was obligated to deliver. And that changes the fundamental credibility of the paper silver market forever. Here's what I am watching today, minute by minute. At the open, silver price direction is the first signal. Up means the physical buyers are front-running the delivery demand. Down means profit-taking and cash settlement relief are dominating. The first delivery notice count, which typically comes out in the afternoon, will show how many contracts formally stood for delivery today. That is the number. Screenshot it. It tells you whether the cash settlement strategy worked or failed. Watch gold's behavior in parallel. Gold near $5,200 with JP Morgan targeting $6,300 by year end means any catalyst, tariff escalation, Iran talks breakdown, Fed policy signal that pushes gold higher will also lift silver. Watch the Shanghai premium throughout the day. If it holds above $10, physical demand is stronger than paper price pressure. If it collapses, some temporary relief is coming into the physical market. Watch lease rates. If silver lease rates continue rising from 8%, physical metal is getting harder to borrow. That is a squeeze indicator. Now let me be direct with you about what I think happens. I am not calling the exact number of contracts that stand today. Nobody knows that yet. But here is what I know. February just delivered 50 million ounces in a minor month. The cash settlement offers were real because the open interest collapsed 44 million ounces in 48 hours, and some of that was not normal rollover. The trading halt on February 25th happened too precisely timed to be coincidental. The Shanghai premium is real. The inventory drain is real. The sixth consecutive deficit is real. And JP Morgan, the entity that issued 99% of January deliveries, raised its gold forecast to $6,300 on the same day the exchange halted. Someone with access to information the rest of us do not have is positioning aggressively on the long side. The weak hands have been washed out. The tourists who bought silver at $121 in January and panicked when it crashed to $64 on January 30th are gone. The leverage that triggered the historic crash has been cleared through 6 consecutive margin hikes and a series of violent sell-offs. What remains are the strong hands, the people who understand the deficit, the institutions securing supply, the industrial buyers who need metal for production, and the physical stackers who see each price dip as an opportunity to accumulate at lower paper prices than the physical market demands. The setup for the next major leg higher has never been cleaner, and today is either the day it begins in earnest or the day we get a final shakeout before it begins. Either way, the direction is clear. Physical will win. The only question is when, and today might just be the day we get our answer. Do your own due diligence. Understand the risks. If you are trading with leverage in this environment, position size matters more than direction. A 10 to 15% silver move in either direction is possible in the next 48 hours depending on the delivery number. If you are a long-term stacker, this is the moment you prepared for. The math you have been tracking for months is live right now. And if you are new to this channel, welcome to the most important 48 hours the silver market has seen since the January 30th historic crash. Everything we have been building toward has arrived. 529 million ounces versus 82 million ounces. First notice day is here. There is nowhere to hide and no more time to manage expectations. Today, the paper meets the physical. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. OG out.